Good afternoon, and thank you for joining us today to discuss the new SBA loan program that has been or is being voted on right now in the House. The House initially took up this bill at 9 a.m. Um, they have been grandstanding at least until right before this, but the anticipation is that it will pass today in substantially the same form as was approved by the Senate, which is what this presentation is based upon. I'd like to thank you for joining us. My name is Stuart McCallum. I'm a partner here at HHM. We are a national super regional accounting firm servicing individuals and medium to large size businesses here in the United States. So today what we'll talk about is the bill, eligibility, the loan, a definition of payroll costs, which has been a question, I think, from a lot of you, what it takes for loan forgiveness, and then what are the limits of the forgiveness of what we are now referring to in this bill as the Paycheck Protection Program. So first of all, this bill is the largest piece of U.S. legislation ever. According to some sources, it's at $2.3 trillion. When we started reviewing the bill, it was 247 pages on Sunday and cost $1 trillion. We're now here 4.5 days later, it's 150% more. However, the SBA portion of this, which is why you are in attendance today, is about $349 billion. So a meaningful slice, however, not the lion's share of this bill. Included in the bill that is currently up for vote in the House and approved in the Senate, we have the Paycheck Protection Program. We have training, education, funding. This is for business development centers. There's some for education, higher ed education, think colleges. There's medical stabilization. Wording in the bill, think of this as face masks, making sure pharmacies have access to the supplies that they need, things of that nature. And then assistance for certain, especially hard-hit industries. Think of airlines in that example, which I believe have $50 billion carved out. Let's talk about eligibility for the program, because there's been a lot of questions. It is worth mentioning that there are really 3 qualifications for this program. That you were in operation as a business or small business or 501c3 as of February 15th, 2020. That you had employees and that you have employees for which to borrow their salary or wages, and that you were negatively impacted by COVID-19 or the coronavirus. So that's it. All right. Were you in operation? Did you have employees? And have you been negatively impacted? Now, beyond that, there are some business definitions that you have to qualify with. So one is any small business, which is the typical SBA definition. For the purposes of this bill, eligible entities have been expanded to include the next 2, which is any business at all and any 501c3. And that is if you have at most 500 employees. Now, the 500 employee count here is based upon the small business definition. But I would note that there's a couple of relaxed standards here. One is some industries can have more than 500 employees. This is based upon the SBA's standard size chart. So when we say 500 employees, it is the greater of 500 employees or the specialized industry employer headcounts that the SBA has. outlined on their website. If you go to Google and you type SBA standard size chart, you'll be able to get the most recent. But for example, if you are a cheese manufacturer, you can have 1,250 employees and still be considered a small business. If you are in Chattanooga here, maybe more specific to us would be rug or carpet manufacturing. If you're a carpet or rug mill, you can actually have up to, but not exceeding, 1,500 employees and still qualify. You'll hear me mention employee counts a little bit later on for some specific cases, but just keep in the back of your mind that as long as you have 500 employees or less, you are generally okay. And then some of these industries have special carve-outs for which you will need to do a little bit of legwork. If you have questions as to whether or not you have a special cap on employee count, feel free to reach out to us. We are happy to address those questions. So on the relaxed eligibility standards here, and this is different from the first bill that you may have read on Sunday, this current bill includes sole proprietors, independent contractors, and the self-employed. So if you are a plumber that works by yourself and you are either organized as an LLC where it's just you or you're a sole proprietor, this bill also applies to you for lending and forgiveness purposes. So I would tell you that there is leeway in the bill for those that have been most impacted by this. And so some of these will apply to you, some will not. But the special carve out that I'm speaking to here is with respect to the NAICS code, which is the North American Industry Classification System. So if you have a NAICS code that starts with 72, which is really the entities listed here: restaurants, bars, hotels, casinos, and strangely enough, RV parks. If you have more than one location, the definition of small business for you is that you have no more than 500 employees per location. So not many hotels, bars, and restaurants, or RV parks for that matter, really care about this. But casinos, this could be a big deal. Large hotels, large resorts, this would also be a meaningful carve out for them. So specifically speaking, if you are one of these categories here, and you have more than one location, more than one physical location, for you to qualify as a small business, you can have up to 500 employees per location and still qualify as a small business. So for this loan, this Paycheck Protection Program, there is no collateral. So there was discussion a couple weeks ago about the disaster relief loan that was also through the SBA, directly through the SBA. There were some collateral requirements for that because it's a regular loan. For this, there are no collateral requirements, none. Zero collateral requirements for this program. Secondly, there are no personal guarantees for this program. So again, unlike any other loan you've seen, there's no collateral and there's no personal guarantees, no exceptions according to the bill that is currently being voted on. This is a very important distinction compared to your typical loan. So as I mentioned at the beginning, as long as you were in operation and you had employees and you were negatively impacted, the SBA wants you, or the federal government wants you to have access to these funds. So do not think of this as a typical underwriting program. I would also mention that based upon my reading in the bill, and I have a colleague here sitting with me, he can correct me if I'm wrong, I did not see anything regarding underwriting standards of credit scores or anything of that nature either. My colleague here says that it actually specifically says no credit. No credit, no problem. What the main purpose of this bill is to get stabilized payroll in the wake of, I'm sure many of you saw the large initial unemployment claims yesterday. The federal government wants to put an end to that. This is the program that they're using to effectuate that. So it is worth mentioning, as I just did a minute ago, the disaster relief loan or the coronavirus loan or whatever you may have heard it referred to as is the B2 loan that the SBA began offering. The window for these loans as it relates to paycheck protection, all right, so these loans will still be available, but for our presentation to be relevant to you, the window for those disaster loans really closes today. So if you apply for this disaster loan today, first of all, you probably won't hear back from the SBA for at least 30 days on this. So if in 30 days they come back to you and say, yes, you have received that, you have been approved for this loan, would you like to take it? If at that point you take it, the forgiveness and all this program goes away for you. If you already have a disaster relief loan, the one question you have to ask is, in that application, did you say it was specifically for payroll? So the original bills, that is earlier this week on Sunday, specifically carved out payroll and called it out and said, if you have a B2 payroll loan, then you cannot be forgiven for these loans. The current bill being voted on in the House says the wording a little bit differently, but the wording still implies that if we were to go out today, if we were to go out yesterday, apply for a loan, and specifically this B2 loan, and specifically say it was for payroll, and then magically we got the loan yesterday, you would have complications with the forgiveness and the paycheck protection program that we are talking about here. You may have specific questions to your particular circumstances. If so, please feel free to reach out to us directly, call us, email us. For those that have asked about it, this presentation is being recorded, so you can listen to it at a later time. The last item that I would mention for the disaster relief loans is that, let's just say that you had a disaster relief loan that you applied for between February 15th and today, and it was just to cover rent. That does not bar you from participating in the Paycheck Protection Program. In fact, if you have a B2 disaster relief loan that is not specifically for payroll, you can actually refinance that or roll that into your 7A loan. To be specific here, disaster relief loans will be available through today and through as long as the SBA declares this a disaster for whatever those definitions are. What I am saying here is that if you want to have payroll forgiveness, as we will discuss later on in this presentation, today or when Trump signs this act into law, if you still apply for this relief loan, it will disqualify you from this payroll. All right, so I'll say that again. Once Trump signs this bill into law, if you apply for the disaster relief loan, you will have complications with your 7A. So for your application of this loan, you will have to make a couple certifications to the lender. One, that due to the economic uncertainty of COVID-19, the loan or the liquidity of the loan is necessary for you or your business. That you will only use the loan for allowed purposes. That is, you will not get a loan from the SBA under this program, pocket the cash, and go to Costa Rica. Cannot do that. We will go through the list of allowed purposes, but you have to certify to the lender that you will use the loan only for allowed purposes. That you have no duplicative applications. So the next two bullet points here are piggyback off one another. One, I cannot go to a financial institution down the street, apply for this program, and then for my entity ABC Corporation, and then go to another financial institution or that same institution and apply for the same program for ABC Corp. You cannot have duplicative applications. You also cannot have duplicative funds under this program. So if I go to my buddy's bank today and apply for the loan, I get approved and I have money on Monday, I cannot then turn around, go to another financial institution or go to my same buddy and fill out an application and receive exact same funds for the exact same issue, right? They want you to apply for this once with one financial institution. You also have to certify that all documents are correct. That is, if you supply tax returns and payroll filings, that they are accurate and truthful. So let's talk a little bit about the loan. So this loan, as it was originally described, which is now defined as the Paycheck Protection Program, is through the SBA's 7A loan program. There are no fees. So there's no origination fee that you have to pay, and there's no application fee that you have to pay. If you already have a loan through 7A that is not specifically stated in the bill, however, I've talked to other SBA lenders, and they do not see you already having an SBA 7A loan as a disqualifier from this Paycheck Protection Program. With this program, you also have deferred repayment. The way that the bill is written, let's say I apply for $2 million today. The way that the bill is written is that I can go to my lender almost immediately and say, listen, due to the economic uncertainty of COVID-19, I would like to defer repayment. That is principal and interest. I can defer it 6 months up to 12 months. You cannot defer it beyond 12 months. But the way that the bill is written, that if I ask for deferment, it seems that the standard deferred period is 6 months. And then the maximum maturity of this loan in practice and pretty much in writing is about 10 years. So if you take out this loan under this Paycheck Protection Program and you have 90% of it forgiven, 95% of it forgiven, 50% of it forgiven, the remaining balance will have a 10-year amortization on it as of the date that the payroll amount was forgiven. And we'll talk about this a little bit here later in the presentation. So let's talk about some definitions that will be important, and I think that there's been some miscommunication and some misinformation out there. So payroll costs, as we discuss them in this webinar and as it relates to this bill, are defined as group healthcare benefits, including premiums, salaries, wages, and commissions, vacation, sick, parental, and family leave, severance or dismissal, payment of retirement benefits. So this was not originally included in the original bill that was proposed in the Senate on Sunday. This is something that was slid into the latest edition of the bill. There is no real definition of it. It just says retirement benefits. I would assume this to mean employer contributions to 401k. I assume this to mean employee contributions to 401ks. I do not know or think that this applies to HSA contributions HSA contributions are a little bit of a fuzzier area, right? Because it's not necessarily group healthcare benefits, and it's not exactly defined as a retirement plan. So HSA, there's a little bit of gray area around it. To the extent that there's state and local taxes assessed on compensation, those are defined as payroll costs. And then, as I mentioned, there's been an expanded definition of who applies or is who's eligible under this loan program: wages and net earnings to sole proprietors and independent contractors. So whatever you are paying yourself, whether it's wages or what hits the bottom line, that is included in payroll costs. Payroll does not include compensation to employees in excess of $100,000. We've had some back and forth here at the office because I think that it's less than clear. The wording is a little bit ambiguous, but I think the consensus here is that the way that this is written is that if you have Bill, and Bill at your company makes $125,000 a year, that the compensation in excess of $100,000 is excluded from your payroll computation. So it's not that all of the $125,000 is excluded. It's just the portion that is in excess of $100,000. Also excluded are taxes under chapters 21, 22, and 24. If you are not familiar with these in your daily vernacular, it's because these are very specific line items in the code of the IRS, including railroad retirement benefits. Payroll does not include compensation to employees outside of the country. So if you have remote employees that have their primary residence in Costa Rica, for example, or Panama or India, they do not qualify for this. If you have a remote employee whose primary residence is, let's say, Kentucky, and he just happens to be in Costa Rica for 3 months, that is allowed. The definition in the bill is where their primary residence is. Lastly here, payroll cost exclusions. Qualified sick leave for which a credit is allowed under the Family First Coronavirus Response Act. So there is the Families First Act that we will not be discussing in depth here, for which you generate credits for qualified sick leave or family leave. What they don't want here is you double dipping, right? They don't want you applying for a credit under one program and then including it in your computation of costs in this program. There are other allowed uses of the loan: rent, utilities, mortgage interest, and interest on other debt obligations. It is important to note here that the last two bullet points say interest, no principal. So if you have mortgage payment that you have to make for the month of April, that mortgage payment, you can cover the interest of that mortgage payment with this loan. You cannot cover the principal of that mortgage payment, and you cannot prepay principal under this loan. The interest on other debt obligations, it's the same thing. So let's just say you are a car dealer and you have a floor plan interest or floor plan loan. You could pay off the interest on that revolver, and we'll talk about it a little bit later, some specifics regarding it, nuances. But you could not, say, pay off a vehicle that was on your floor plan using the funds on this loan or program. The maximum amount of this loan is $10 million. So your average, this is computed based upon your average monthly payroll for the past year, not last year, which would be January 1st, 2019 to December 31st, 2019. This is your average monthly payroll cost for the past year, which would be, let's say, today going back 12 months. you will take your payroll cost that we just defined and multiply it by 2.5. Plus, as I mentioned, if you have an outstanding balance from a disaster relief loan that you received, so this isn't applied, this is if I had already applied on, let's say, February 10th, I applied for a disaster relief loan and I've already received it, I can increase the amount of this Paycheck Protection Program SBA loan. I can increase that loan application by the amount of the outstanding balance of the existing B2 disaster relief loan. So if I apply for a loan in a week, this disaster relief loan in a week, I cannot apply for the 7A, this protection, what we'll call PPP, the Paycheck Protection Program. I could not apply under the PPP and expect to get the outstanding balance of the loan that I have not received yet. So it is between, the outstanding balance can only be added to my loan application or loan amount January 31st, 2020 through whenever this bill is enacted. So once Trump signs this, we will no longer have the ability to refinance under this program. Now, for those of you in Nashville, it is possible that you have disaster relief loans related to tornadoes last month. If you have this fact pattern, please call us. I think that we will need to dive into that matter a little bit more than what we will discuss today during this webinar. So, exceptions for computing monthly payroll. For seasonal businesses, the average month can be the 12-week period beginning February 15th, 2019. So they're trying to match up the covered period of the loan that we're talking about now with the qualifiers. So you can take the 12-week period beginning February 15th, 2019, or March 1st, 2019 to June 30th, 2019. So these are for seasonal businesses. You may be asked and may need the approval of the lender to make this distinction of being a seasonal business. But so just to be clear, if I'm a standard business and my payroll does not fluctuate, I'm going to take my average payroll costs for the past 12 months. If I'm a seasonal business, I can use these two criteria. For businesses that were not in operation prior to June 30th, you can choose the option of taking your average monthly payroll costs, as we've already defined them, between January 1st of this year and February 29th of this year. You may have questions. This is, here, I'll go back a slide. So for everybody, for your average business, it's average monthly payroll costs for the past year. For seasonal businesses or businesses not in operation prior to June 30th, 2019, this is how you are going to compute your average monthly payroll costs. If you have questions, feel free to ask us. If not, please feel free to reach out to us after the webinar. This webinar will be recorded and available to you through our blog as soon as we get done today. So let's talk forgiveness. What qualifies? There's been a lot of misinformation. What qualifies payroll costs as we've already defined them? Interest payments on covered mortgages. So as I told you, the allowed use is interest on mortgage payments. Here, what qualifies for forgiveness are covered mortgages, and that is mortgages that you entered into prior to February 15th, 2020. So if you went out on Monday and got a mortgage, it does not qualify for forgiveness if you're paying interest on it. Covered rent payments, it's the same stipulation. If I entered into a lease agreement yesterday, those rent payments are not eligible for forgiveness under the Paycheck Protection Program. Covered utilities, so this is gas, water, electric. These, again, you had to have service set up by February 15th, 2020 for them to be eligible for forgiveness. How to be forgiven. So actually, I will go back here for a second. If it's not on this list, it does not qualify for forgiveness. Doesn't matter what your banker tells you. Doesn't matter what anybody else tells you, what the media tells you. As it's defined in the bill, you got payroll costs, you have interest on covered mortgages, covered rent payments, covered utility payments, and then included in mortgages here is the debt obligations that we mentioned earlier. So dealers, if you have floor plan and you got that floor plan before February 15th, I believe your interest payments on that floor plan is a covered expense, which is reimbursable. I would tell you that the safest place to be would be for dealers is if you had a vehicle on your floor plan as of February 15th. So those funds were already assigned to that vehicle as of February 15th. Now, I hope you don't have vehicles that aged, but if you do, it seems pretty clear to me that the interest on those vehicles would be covered and forgivable. So again, payroll costs, rent, utilities, interest on covered mortgages, and interest on debt obligations that, again, you took on prior to February 15th, 2020. So let's talk about how to be forgiven. You have to submit documents to your lender. The application that we're talking about, to our knowledge, has not been drafted yet, but lenders have an idea of what they want. This is necessary to be forgiven. So if you take out this loan under the Paycheck Protection Program and you don't file for forgiveness, you cannot be forgiven. I would also suggest that $350 billion that they've set aside for this SBA program is a lot of money to me. It's a lot of money to you. It's a lot of money to my colleagues. It is not a lot of money divided by 350 million Americans. So to the extent that you know you are going to apply for forgiveness, you should draft and collect those documents as soon as possible and then file as soon as possible with your lender. So documentation here is key for forgiveness. It's called the Paycheck Protection Program. So payroll is key in getting forgiveness. So in order to document and verify your payroll, you need to verify the number of FTEs, full-time equivalents. So this is different than the number of employees we talked about earlier. Full-time equivalents is employees that are defined as having 30 hours or more per week. So if you have, the SBA's example was, if you have 2 employees that only work 15 hours a week, together they count as 1 FTE. But for your forgiveness documentation, you'll want to supply the lender something verifying your full-time equivalent, headcount, and pay rates. Figure tax roll or payroll tax filings and unemployment filings. For mortgages, rent, utilities, and other covered debt, canceled checks, payment receipts, and then a printout of your good old-fashioned bank statement, right? So with these, the lender can get some level of comfort that the funds that they distributed to you was spent in accordance with the forgiveness program in the bill. Now, there are limits on forgiveness. Limits. So the limits on forgiveness, first of all, can't exceed the principal. So if they give you $2 million, in the case of this tipped employee example, if they give you $2 million for payroll, you can't ask for forgiveness of $2.5 million for payroll. They can only forgive you up to the amount of loan that they issued you. There are then two limitations, and I know that we have some questions here when people have trimmed headcount. There are a couple of limits, and then there's a remedy that we're going to talk about. So first of all, if you had a reduction in headcount, the reduction in headcount is computed as average number of full-time equivalent employees during the covered period, which is February 15th to June 30th of this year. So take your payroll or your pay periods, look at the number of full-time equivalents that you had per pay period. So let's just take the month of May, for example. If I have 2 pay periods in the month of May, if I have 50 employees for the first pay period, 50 full-time equivalent employees on the first pay period, and I have 30 full-time equivalent employees in the second and last pay period for the month of May. For that computation, I have the average of those 2 pay periods. So if I have 50 and 30, that means for the month of May, for this computation, I have 40 employees or full-time equivalent employees. So the way that we're going to, and we have an example on the next page, so you could take a picture of this slide if you'd like. This is computed, your reduction in headcount is computed as your average number of full-time equivalent employees during the period between February 15th and June 30th, and divided by the average number of full-time equivalents per month between the same period last year, so February 15th, 2019 through June 30th, 2019, or the average number of FTEs per month between January 1st and February 29th, 2020. So if you were not in operation before June 30th of last year, you could use the second computation. Here's an example of this. So if I have, on average, 150 employees, full-time equivalent employees, right? If I have, on average, 150 FTEs during the covered period, which is this February 15th through June 30th of 2020, and I compare it to last year, and last year during the same period, I had an average of 250 employees, then the quotient of dividing those into each other is 60%. If I had forgiveness allowable of $2 million, I am now only forgiven or forgivable for the 1.2 million. We have a second qualifier, which is a reduction in salary. And so this is more specific. So just to be clear here, this is employee count. This is not specific employees. This is specific employees. So this is if I have an employee and I reduce their salary by 25% from the most recent full quarter before the covered period. So that would be Q4 of 2019. If I reduce their salary by 25%, then it doesn't count against me for forgiveness. If I reduce somebody's salary or wages or hours by more than 25%, then there is going to be a reduction in the amount of forgiveness that I'm eligible for. And for this, we will say for employee, this is any employee who did not receive wages or salaries in excess of $100,000. So here's an example. Employee number 1, number 2 were not employed during Q3. Employees 3 through 7 were. Now, Q4, as I mentioned, was the period in which we have the decline in their pay that we're measuring. So here we have Q4, and you feel free to take a picture of this. So their quarterly compensation, employees 1 through 6 got paid $5,000 each, and employees 7 got paid $37,500. We'll call him the owner. So for the covered period, which is at February 15th through June 30th, employee 1 saw a decline in their compensation to $2,000. Employee 2 did not see a decline. Employee 3 did not see a decline. Employee 4 and 5 saw a decline. Employee 6 saw an increase. Employee 7 saw a decrease. You'll see here we've computed differences. That is, reductions in those salaries. Allowed reduction in their salaries is at 25%. And so we have here computed excess reduction. The way that I read the law, employee 1 and 2, because they were not on the payroll early enough, their reduction does not count. For employee number 3, there is no change in his salary or her salary, period over period, so that's not computed. For employees 4 and 5, they have seen a meaningful decrease in their salaries. And because their salaries in the covered period are less than the full quarter preceding the covered period, we have that excess reduction. That is, we decrease their salary more than the 25% limit. So our reduction in loan forgiveness is computed there in the far right column. Employee number 6 saw an increase in his wages. Note that the increase in that employee's wages does not offset the loan forgiveness of the employees that saw pay decreases. This is for specific employees. We then see here in employee 7 that this is what we see as a highly compensated employee. The way that I read it, he is excluded for the purposes of this calculation. The way that I read it, this is for our benefit, right? So if I'm the owner and I made $100,000 or $500,000 last year, and this year, because of the hardships, I'm not going to cut myself a wage, I don't want that deducted from the rate of from the amount of forgiveness, right? So here you can see at the bottom row, which is the totals, the total difference for total compensation is 63% down. However, because only certain employees actually are eligible or considered in this computation, we only have a reduction of 6.7%, or that $4,500. There will be significant questions related to this schedule. It is relatively convoluted. I would ask you, if you have questions, to reach out to us to help you create a schedule when you are applying for forgiveness, so that you understand what loans you can have forgiven. But I will tell you that there is a remedy such that none of this matters. Rehires, and I know some of you have asked a question about this. For employees or salary cuts between February 15th and then hopefully 30 days after today. So it's 30 days after the act is passed. Let's hope Trump signs this in a big charade this afternoon so that the 30-day starts today. But to the extent that employees or salary cuts were made between February 15th and let's say mid-April, there are some remedies. Headcount reduction between February 15th and 30 days really after today. It is headcount can be restored. So I will emphasize here, it says replace no later than June 30th. And so here I have an example. The first example said that I have 40 full-time employees on February 15th. Even if I had 10 employees in April, but by June 30th, I'm back to 40 employees. Then from the standpoint of this bill, I have restored my headcount. And so the headcount reduction that we computed a few slides ago does not count. We're good. We do not need to consider that reduction of my forgiveness amount. Let's say the second example on the bottom. Let's say I have 40 employees on February 15th, which is the measurement day for employee cuts. Let's say I kept 40 employees all the way till June 29th. And then on June 30th, I reduced it to 38. And then I reduced it to 38 on June 29th. And on June 30th, I have 38 employees. That would be an issue. So here is not specific employees, it is full-time equivalents. It is important to note that if you get or receive funds under this program and you say you're going to use them for payroll, you should use them for payroll. That is, you should not sit on the money for the next 6 months and then decide that you're going to deploy it. And I'll say that for a couple of reasons. One, I got a note from my colleague here that said that you have 8 weeks after origination, a covered period. I would also mention that from our understanding, and as we mentioned earlier, there is going to be, let's say, a run on the bank, right? There's only so much money to go out there. And so I would want to be the first one to apply for the loan, and I'd probably also want to be the first one to apply for forgiveness. So if you remember, there were two ways that we measure a reduction in the forgiveness of the loans. One is the head count, the other is salary. It is important to note the salary is employee specific. So you'll see, I don't say replace, it is restore. So if I have an employee here in this example, they each get paid $5,000 a month. And on February 15th, each of them is making $5,000. And on June 30th, employee one's making $5,000, but employee two, and it should be employee three down there, are making $2,000 and $4,000. That doesn't help. And I would tell you that in order for your rehiring to absolve you of these reductions and forgiveness that we talked about, the headcount and salary, both of these rehiring qualifications need to be met. So if you had 40 employees and you added back 40 employees, you're okay here. If you come here and you don't increase employee 2 or 3's salary back to normal, then both of the forgiveness limitations that we discussed earlier on are in full effect. So this is not a either headcount or salary are rectified. You need to restore both. This is important. It's not one or the other. You have to do both. You have to restore your employees' salaries, and you have to restore your full-time equivalent headcount by June 30th. I will mention here, because I know there's quite a few dealers or dealerships on the line that are interested in talking about specifics for them. If you are a new franchised car dealer, for you to be eligible under this paycheck program, it is my understanding that your franchise needs to be on the approved list for SBA franchises. And this is specific related to the affiliate rule. The affiliate rule says that I can have up to 500 employees at my company. However, if you own 10 dealerships and each of those dealerships has 75 employees and they are all owned by one dealer or under the same structure, same control structure, that bumps your employee count above the 500, and so you no longer qualify. There is an exemption or a waive of the affiliate rule in this bill, such that if you are an approved franchise, they will look at the employee count of only that legal entity. So this is important for two reasons. One, it is our understanding that as a franchise, you need to be on the approved list in order to get an SBA loan through this program. Furthermore, if you have a dealership group, you need to be on that franchise approved list in order to be waived of the affiliate rule of 500 employees. If you have questions, please feel free to reach out to us. We're happy to be a resource. Beyond that, I do believe
we're going to add a lot of these questions as Q&A on the slide.
Yes. So we have received Q&A. We cannot get to all the questions. We will, when we save the slides in this webinar online, we will include answers to the Q&A that are not specifically addressed during this webinar on the slides when we issue them. A couple of other things that I would want to mention regarding dealerships. As I mentioned early on, I believe that your floor plan interest would be considered a covered debt obligation so long as you had the revolver prior to February 15th. And again, it would be only for the interest. For our independent car dealers on this, you have no franchise, right? So you don't have that limitation. What you would need to make sure is that within your organization, you do not have 500 employees or greater. Well, you do not have greater than 500 employees, because the affiliate rule will apply for you. So if you are an extremely successful independent car dealer and you have, let's say, for example, 30 dealerships and 700 employees, the affiliate rule still applies to you. So that 500 or an excess of 500 employees bars you from applying for this program. However, I do believe that consistent with new car dealers, that your floor plan interest expense, again, no principal, would be an eligible and covered debt obligation under this bill, assuming that you had your floor plan in place as of February 15th, 2020. We do have a few questions here. There are franchises that, for dealers specifically, that are and are not on the list. That list has changed dramatically over the last few days, as you can imagine. But looking at the list prior to this week, Kia was on there, Ford was on there, Chrysler, Dodge, Jeep was on there. Honda Power Sports was on there. Lincoln. I understand that Toyota and Lexus are either have been added or will be added in the immediate future. Nissan, I think, is working to be on the list, and Honda is working to be on the list. Oh, and I forgot, Subaru is included on the list of approved franchises. We have a question regarding employees that maybe they asked for a reduction in salary until things got back to normal. I would tell you that while that is noble, that does not help you in the eyes of this bill. The purpose of this bill is paycheck stabilization, right? They have drafted this such that whatever somebody made at the end of last year's quarter is what they will make for the next however many weeks this covered period is. That is ultimately the goal of this bill. So if you do have employees which have voluntarily accepted a pay cut, I would recommend, if you are only interested in complying with the eligibility requirements of this bill, I would recommend that they are restored to full compensation so that you do not have limits on your forgiveness that have been discussed here. We do have quite a few questions that we will likely have to address in a Q&A packet that will be attached to this presentation when we upload it. A recast of this will be available momentarily on our blog online. I'd like to thank each of you for taking the time to join us today. Please feel free to reach out to us if you have any questions, concerns, or would like to discuss the application process or any questions related to this. We are happy to be a resource to you. I'd like to thank you for taking the time today. Thank you very much.